There is a dirty little secret in the world of investment real estate that pretty much no one wants to talk about, but listeners of the show should 100% be aware. In fact, it's particularly listeners of this show that need to understand that this is something that goes on in the industry, and you must be cognizant of this when you're going through the due diligence process, especially as a passive investor. So one thing that I have tried to do on the show is I want to give you the playbook for understanding the world of syndicated commercial real estate. I want you to understand the different asset classes, the industry leaders, what their perspectives are, how they underwrite deals, how they look at markets, how they think about new opportunities and analyze them on a risk-adjusted basis. And one of the things I want to give you is the ability to look at deals and try to understand if they should be invested in for your own personal portfolio, or if you raise funds and create a fund of fund, would it be appropriate for the investors in that fund of funds? Now, with those tools comes a bit of a responsibility. So if I give you the tools and you learn the tools of all the questions you should ask when it comes to conducting due diligence, which I've tried to do, and also many, many guests in this program have done a great job of. Once you have those tools, you have to use them in the right way. And here's what I mean by that. If you understand this space to a large degree, there are levels and levels and levels to this game. You can talk about deals for hours and hours and hours. But there's a big difference between you talking about those deals and taking the operator's time. Because operators typically work with investors that are willing to fund without going to the level of detail that a lot of listeners of this show are interested in going. So I'll give you an example. If you get a deal and say, oh my gosh, I want to learn everything about Vegas. I want to learn everything about the loan terms. I want to learn who the lender is. I want to learn at what point does the loan stop being able to be paid down and all of these things. The goal should be for you to figure as much of that out on your own before contacting the operator or without contacting the operator. You should have a very solid understanding of the deal and try to push and pull the model in whatever way you can so that the time with the operator is specifically for things that you can't figure out on your own. You want to get their perspective on these matters, but you shouldn't be going into the conversation blind. Here's why. Especially in today's environment where the world of syndicated opportunities is becoming more and more popular, and in a world where people are more and more hesitant to invest in the stock market, and for good reason, there's access to other capital out there, especially if you're talking about investing $50,000. So when I look at a deal and I'm thinking about investing $50,000, I try to put a limit of the time that I'm going to take from the operator at about 2 hours. This is with a new operator that I haven't yet invested with, that I want to build a relationship with, and most importantly, I want to invest with passively. So I don't want to take more than 2 one-hour calls if I'm investing just strictly passively for my own personal portfolio, not bringing other investors in, not raising a fund of funds or doing anything like that. Now, the reason I say this is that when they can find easier access to $50,000, when the questions start mounting up, they tend to do so. And I myself have missed out on many deals by sending sponsors a very detailed list too early on in the relationship of questions that say all these super, super detailed questions that most investors aren't going to ask. They go, well, guess what? The deal's actually been filled up because we're just looking for $50,000 and we found another way to get $50,000. Now, an important part of this conversation is that you can work your way into that level of detail. In fact, I think it's prudent to do so. You just don't want to hit them with that initial email up front, which implies you may be kind of a headache to work with, and it's obviously going to take a lot of their time. Now, as you grow your business, let's say that you do want to create a fund of funds model, create an entity, have your investors invest in that entity, and then invest into another sponsor's deal. Now, instead of raising $50,000, maybe you're raising $500,000. So you're raising 10 times or investing 10 times that original $50,000. Now, does that mean that you should spend 10 times more on due diligence? Well, you can, but the question then is it still possible for the sponsor to find another way to find $500,000 in that instance? And my guess would be, yes, it is. Because if you're talking about 20 hours of the sponsor's time for $500,000, again, the math is not favorable. So what you can do to make it really favorable is if you want to create a fund-to-funds model, have your investors invest into your entity and then invest into a sponsor's entity, you can actually negotiate favorable terms for doing so because you're investing so significantly, whether this be through creating a class of shares specific to your investing entity or a side letter which attributes your investment amount to a preferential treatment, whether that be through a higher preferred return or a more favorable split above the preferred return or a combination of both. So my point here is that to make this advantageous enough for the sponsor to give you preferential treatment to that entity, you don't want to spend 10 times the amount of due diligence to invest 10 times the amount of capital. There should be a more favorable ratio. In fact, I think if you were to take 5 hours or maybe 10 hours of the sponsor's time to invest $500,000 and get preferential treatment, that is actually how this business is done to a large degree. Because as you can see from the sponsor's perspective, as those numbers get higher, the marginal return for dealing with you becomes larger and larger and larger. Because you don't need to do 50 hours of due diligence to invest whatever, $2.5 million. At a certain point, you know pretty much everything there is to know about the deal within a reasonable margin of error, and the sponsor is financially incentivized to deal with you or your investing entity, as opposed to 50 individual investors that may each take an hour of their time or 30 minutes of their time on average. Now, the reason I say all of this is that we don't want the industry to push back so significantly on sophisticated investors that all the sophisticated investors are not investing in the deals alongside you because there's easier ways to get that money. So what I'm suggesting you do is when you get a deal that you're interested in investing in, take a second, go through the 7 stages of conducting due diligence, which I have provided previously. If you haven't received that yet, it's a keynote presentation I did at IIREC. You can get all of the IIREC videos at intelligentinvestorsrec.com. Or if you want specifically that presentation, shoot me an email at hunter@asymcapital.com. I'll send it over to you. There's 7 stages of due diligence that I talk about in that keynote presentation. I would take that deal, go through those 7 stages, and try to fill in the blanks as best as possible. You will certainly have some things that come up that you can't answer on your own. Then take those questions to the sponsor, schedule a 1-hour call, and if you want to, send him the questions or her the questions prior to the call so that they're prepared. And that 1 hour should be extremely detail-oriented. You can learn a ton if you are pointed in your questions. You already have a good foundational understanding. By the end of that hour, you know more about the deal than 80% of the people that are investing in it. Then take a week, think about the information the sponsor provided to you, go through and continue to learn a second level. If you have another round of questions, that's totally fine. Review the legal documents if you're still contemplating investing. Send the questions ahead of time, book the second call, 2 hours in. Oh my gosh, you're an expert. And you've done this by only taking 2 hours of the sponsor's time. So that's a very powerful strategy. I don't want you guys to burn your relationships with sponsors too early on by basically flexing and go, I listened to the Cash Flow Connections podcast and all the other podcasts out there for the last 3 years. This is my first deal. I'm going to make you know that I'm the most advanced investor you've ever had. Because that can burn a relationship, even with people that love having advanced investors, which we 100% do. I like it because the more advanced the investors, the less likely it is that we'll put out a deal that will be a success. It keeps us all in check. And trust me, when I have investors that have been investing passively full time for the last decade that love a deal we put out, it feels very good to know that we're seeing eye to eye in a very important topic. So hopefully that helps. Again, if you're interested in checking out that keynote presentation, shoot me an email at info@asymcapital.com and request that keynote presentation. All right, hope it helps. All right, listeners, you know the routine. This show is all about learning, making wise investments, and protecting and growing your capital. So if you're interested in these topics, make sure to hit the subscribe button. Of course, If you've already enjoyed a couple of great episodes, don't be shy, leave a review. It really helps the show's visibility. And lastly, if you're an accredited investor and you're interested in learning more about our investment opportunities, the types of deals that I personally invest in, go to asymcapital.com. That's ASYMcapital.com. Thanks a lot.